I am not a financial advisor, and this podcast is for informational and educational purposes only. The content discussed here is not intended as financial, investment, tax, or legal advice. Always consult with a qualified professional before making any financial decisions. Past performance is not indicative of future results. All opinions expressed are my own. Aloha and welcome back to the week that was, your weekly market recap. I am your host, Colin Edsman, and this week was, as always, chocked with news and updates. It was all over the place, but the overall umbrella is still roughly the same, so there's not too much things going on, but let's check in and see what happened this week. A couple of different things we're going to cover are going to be... Hold on, let me just get my list here. I hope you're having a great week wherever you are, whenever you are. Right now is a little after 8 p.m. on Friday, May 22nd here in Hawaii. A little bit of a gremlin or two. As you can see, I had to jump from one live broadcast to another, so thank you for sticking with me. I hope you're here in the chat with me. Looks like everything's working well. Mic is on. Videos on. All right. So some of the things we're going to go over this week are, let's double check. Yep. We're going to go over what the S&P 500 did. We're going to see what NVIDIA earnings and some key events around that. Bitcoin, as well as the bond markets, because that's going to be very important. That's basically the most important thing moving forward. Until we can get that in check, we can't really talk about anything else. But the stock markets, records, reality check, it was all over the place. But let's get into it. So the stock markets were at records high midweek, climbed to over 7,500, new record. NASDAQ also hit records, closed around 26,000. Dow Jones reclaimed 50,000 for a little bit. Here's a little bit on the bond market. 10-year yield, 30-year yield, both elevated. NVIDIA reported midweek, strong numbers, but as usual, if you're a bull holder of NVIDIA or just a regular watcher of the stock and earnings, they don't do well after earnings. So this wasn't a new story. They had an initial pop and then retraced a little bit. Bitcoin traded between 76,000 and 78,000, showing resilience, but no major breakout. Precious metals were mixed, gold pulled back, but let's go into some big picture stuff with the stock market. Press the wrong button there for a second. So here, let's break down the daily moves of the S&P 500 this week. The markets was a classic tale of two halves, strong momentum and fresh record highs early in the week, followed by a reality check, sell-off on Friday, driven by rising yields and persistent oil concerns. Early in the week, markets built on recent momentum. The S&P 500 pushed above 7,500 intraday, midweek, setting multiple new all-time highs. The NASDAQ also carved out fresh records, fueled by continued AI enthusiasm rotating into broader sectors. That's going to be a big thing to think about moving forward here. Are we going to get some sort of broader sector rotation? We have to deep dive into that. We'll touch base on it a little bit later. The Dow briefly reclaimed the psychologically important 50,000 level this week, so congratulations there. Friday there was a sharp pullback, reality hit, the S&P 500 dropped 1.2%, around 74.08. The Nasdaq fell 1.5% to 26,225, and the tech and growth names leading the decline. The Dow shed about 500 points to finish near 49,526. As far as the full week performance goes, S&P 500 slightly positive overall, Nasdaq modestly negative, Dow roughly flat. Now, with the sector rotation and focus, this week highlighted a clear preview of what we're going to get. Winners, energy up 2.3% on Friday alone, up strongly for the week as oil stayed elevated. Materials and industrials also showed relative strength earlier. Here's some of the laggards. Tech and consumer discretionary, as well as rate-sensitive sectors like utilities, real estate. They took the brunt on Friday as yields bonds spiked. We're going to get into that a little bit later, but man, we have to keep our eyes peeled on the bond yields. Small caps like on the Russell 2000 underperformed. Large caps again down over 2% for the week in some reports. Despite the Friday sell-off, the market showed impressive underlying resilience. It hit records even with sticky inflation and geopolitical noise, a sign that AI momentum, solid corporate earnings, and selective rotation into real economy stocks are providing a floor. However, the late week weakness is a reminder that higher yields and oil prices can quickly cap enthusiasm. This sets up an interesting dynamic heading into next week. Will buyers defend these levels, or does sell them may start to bite a little bit harder? Honestly, I couldn't get a definite signal off the week. Everything feels a little bit on the expensive side for me personally, so I'm not buying a whole lot of things right now. Still continuing my covered calls. Just sell options and relax a lot of the time. Sometimes I get a little bit agitated and I feel like playing with a intraday type thing, and then I remind myself, wait, we aren't in that kind of motion right now. So we just got to keep our eyes peeled, stick to our system, and take our profits. We have to constantly remind ourselves that the profits itself is all imaginary until you take them. But you got to think about what you gain outside of the stock market and keep your views realistic. Your savings account, for instance, doesn't gain a whole lot in a year, maybe 3-4% somewhere in there. So if you can make 3 or 4% on your principal per week, you're doing a great job. Or even in a single trade, getting 5, 10, 15%, that's huge, right? So be realistic. Stop trying to double your money all the time. Some of the profits and some of the gains out there don't belong to you. So it's important you think about what is yours, put it in your pocket, and you move forward. Try not to get too distracted by what other people are doing. You got to remember that comparison is the thief of joy. Other people have worked harder and maybe they're farther along. Some people are just beginning and you're somewhere farther along than them. This is all a trail that we're walking, and it's different for everybody. So keep yourself realistic and stick to your plan. Now, let's get into the bond yields here for a moment. After that choppy week in the stocks, let's move into the asset class that's really stole the spotlight, the bond markets. This was a rough week for the bonds as yields continued their sharp climb higher. The 10-year Treasury yield rose noticeably this week during closing near 4.59%, its highest level in nearly a year. The 30-year bond yield pushed even higher, hitting 5.12% at points this week, marking its highest close since 2007 in some sessions. Shorter term rates also moved up, with the 2-year yield climbing above 4.15 to 4.20% area. This is one of the stronger weekly sell-offs in treasuries we've seen this year so far. Bond prices move sharply lower as investors priced expectations around inflation and Fed policy. Now, congratulations to Mr. Walsh. He just got his first official day, and I don't know what you call it. He stepped up to the podium. Mr. Walsh is now the Fed chair. Congratulations. He's a crypto bull, but he also inherited a very dodgy market. So we're going to have to watch his first few sessions and see how he does. This year there are literally no price cuts priced in at this point. Rate cuts, priced in. There's a likelihood we get a rate hike this year. So Fed Chair Walsh has his hands kind of tied, even if he is sort of a crypto native pusher. But what drove the sell-off this week was hotter inflation pass-through. Persistent strength in oil trading above $100 to $109 kept feeding into inflation fears. Fed minutes this past Wednesday, the April FOMC meeting minutes showed officials increasingly comfortable with higher for longer stance. There was a little urgency around rate cuts, with several members highlighting sticky, shelter, and energy components. The technical selling, though, as yields broke key resistance levels, momentum traders and hedge funds piled into the move, creating a self-reinforcing spike. Here are some of the market implications in that area, though. This rise in yields can have a ripple effect across the entire market. It weighed on rate-sensitive stocks like real estate, utilities, and growth tech valuations. Mortgage rates moved higher again, which could eventually slow the housing market. And the housing market is a large portion of the national market cap, for instance. It's almost half. Let's say the stock market's at 50 trillion, the housing market would be worth like 40 trillion. They're pretty comparable, but we don't talk about the housing market enough because we know that the rates are high for what people can afford. Like, if people could afford this rate, more people would be in homes. Now, the average first-time home buyer is now aged above 38, maybe even 40 at this point, when 20 years ago the average home buyer was, or the first-time home buyer was in their 20s. The bonds are sending a clear message right now. The era of expecting easy rate cuts on pause is on pause. The market is pricing in a more stubborn inflation environment driven heavily by energy and geopolitics. While this creates pain in the short term, the higher yields also mean better income opportunities for new bond buyers and retirees looking for fixed income. So this is still a great thing for some people, but it's still a tough situation for the market as a whole. For next week, we're going to be looking at the bond market, and we will stay in front and the market will stay front and center. Any signs of cooling in the oil prices or dovish comments from the Fed speakers could trigger a relief rally in treasuries. But until then, higher for longer regime remains in control. Next, we're going to be talking a little bit about NVIDIA earnings. Now, that's a huge market mover. It's a large weight of the entire stock market and the S&P 500, as well as a large percentage of the global market. So, some of the big things that happened this week around NVIDIA were the revenue, the data center revenue, gross margins. There's so much we can talk about it. I watched some of the old information, like old being like weeks, not years. So there was a conference that Jensen Huang was at. He was being interviewed. Go check out that pod and the rest of the interview after that. That's linked in that pod. It's a great crash course on what NVIDIA does. Even if you're not directly invested in them, you have an investment in some way just because of the size and the reach of this company. This was the moment during NVIDIA's earnings. This was the moment in the week. NVIDIA's earnings was the huge kind of spotlight, and the entire market had it circled on the calendar. And it delivered a classic strong numbers but mixed reaction outcome. Here's what NVIDIA reported. NVIDIA posted another blockbuster quarter. Revenue came in around 78 to 80 billion, smashing expectations and showing 79 to 82% year-over-year growth. Data center revenue once again dominated, with contributions from Blackwell platform ramp. Gross margin stayed healthy in the mid 70% range. Guidance for the current quarter was solid, but largely in line with elevated Wall Street expectations, no major blowout or disappointment. The market reaction had an initial pop. Shares rose after hours trading on Wednesday, helping push the Nasdaq and S&P to fresh record highs mid-week. Later digestion by Thursday and especially Friday, NVIDIA and the broader semiconductor space gave gains back. Profit taking kicked in and the buy the rumor, sell the news trade played out. The stock ended the week mixed but strongly on the week overall, but well off its peak reaction. Somewhere about the 225 range, we're probably somewhere about the 220, 218 range. The broader tech and AI impact. Earnings reinforced the AI infrastructure theme, but also highlighted rotation. Winners, traditional energy, industrials, and materials outperformed as money rotated. Laggards, some of the high valuation AI names and high rate sensitive tech, felt pressure from the rising bond yields. The Mag 7 as a group was mixed, but NVIDIA still leading but showing signs of fatigue after a massive run. NVIDIA continues to prove it's the picks and shovels winner of the AI boom. The report validated the secular growth story, but the muted follow-through shows how high expectations have become. In a higher yield environment, even great earnings aren't enough to keep everything flying higher. This earnings season continues to show a healthy broadening of the market away from just a handful of AI names. into more a real economy sectors. That's generally a constructive development for the longer term. This is, it's hard to think about years and years down the road when you're young, because your life is pretty short. So when you have to think about 10, 15 years down the road, it feels like an eon. But it's important to think about what's coming for you. Prepare for it if you can. You have the time now and the ability to see, so it's important you consider what could be happening in the future. So now we're going to get into a little bit how the oil and geopolitics worked out for the week with the overall macro backdrop. So let's move from NVIDIA and tech to the factor that dominated the week: oil and geopolitics. Oil price action stayed elevated and volatile throughout the week. Crude oil futures traded mostly in the 102 to 109 range. Brent briefly touched above 110 before settling around 107 to 109. The market remained in strong backwardation, signaling tight near-term supply. Let's go! What's up, Quantum Queso Dip? Welcome to the chat and welcome to the pod. We're getting into some of the overall macro. Let's get into some geopolitical drivers. The primary catalyst remained ongoing. Tensions in the Middle East are still a big concern. We're still looking at the Strait of Hormuz again. I'm really tired of talking about this part of the world, but it's still a massive mover in the market, so we're going to have to keep covering it until it's done and over with. And this could be a while, so by the time the Strait of Hormuz and the global oil crisis gets over with, I'm probably just going to be an expert in oil. Who knows? Next year I might just trade oil at this point because I have to cover it so dang much. But concerns over the Strait of Hormuz, through which 20% of the global oil passes, still kept a significant risk premium on prices. US-Iran diplomatic efforts showed mixed signals, as always, because they are honestly just not coming to a decision on purpose. I don't know what they want. They don't know what they want. It seems the stock market's doing fine anyway, so nobody really cares. Which means that none of this stuff is really priced in. So the summer months could be a tough time for families, especially when families tend to travel for the summer. We're going to see a lot of people not doing air travel, maybe resorting to RVs or staycations. It's going to be really interesting for us locally here in Hawaii, because of how much of our economy is reliant on, well, tourism. And surprise, surprise, most of those, if not all of them, have to get here by plane. And plane uses fuel, and fuel costs are going up. So this geopolitical uncertainty continues to act as well as the main transmission mechanism, pushing inflation higher and keeping the Fed on hold. Especially with Walsh coming in, he doesn't want to have to do this, but hey, might as well just pull off the band-aid, eh? The broader macro implications. The hot oil prices fed directly into last week's sticky inflation narrative and the bond sell-off. It also supported a clear sector rotation. Energy, materials, and defense outperformed, while high duration growth names lagged. No major recession signals emerged. I'm looking at the Kalshi traders, and they have a recession this year priced in at like 16%. So we're in pretty good condition as far as avoiding a recession of some sort. But the combination of higher yields and energy cost is starting to create more challenging of a backdrop for rate sensitive parts of the economy. So we have to keep our eyes on what is affected by the rates when we start doing our trades moving forward. Whether it's something that could be pushed by a good trade or being held down by a good trade. Open Door is a good example. I don't see Open Door getting above $6 anytime soon. But also I think it's found a good floor about $4.20 and $4 as well. Oh, you are 100% right. And Quantum Queso Dip just said quantum stocks are on fire. And that's due to some government interest, the CHIPS Act. I love qubits, and I'm honestly thinking about getting back in that position, which is D-Wave Quantum. After the volatility at the end of last year, I decided to close my position, but now that we're getting more of a push on it, if this sustains, yeah, I think I'm going to start buying my way back into D-Wave Quantum and seeing a $44-$50 price target again for that company, as well as Rigetti Computing and some other names that I can't remember at the moment. But yes, thank you Quantum for reminding me of that. That is huge. Now that's a good time to bring up the next portion, which is our Bitcoin and crypto segment. Let's shift from our traditional macro and oil into the digital asset space. My friend, Bitcoin. Now, today, as well as this week, but mostly today, I discovered the fun of trading the 15-minute price moves on Kalshi. Now, it's difficult, so I wouldn't recommend it because it's not a gamble, but it's been an interesting practice run on trading fast futures. Now, I try to keep it a high chance of profit, so I'm looking for 90% or higher, but sometimes that goes against you too, so because that's 9 out of 10 times the trade doesn't work out. So I'm still trying to figure out the mechanics there, but I'm having a great time with it. But as far as the price action this week goes, Bitcoin showed resilience in a choppy macro environment. It traded mostly in the 76,500 to 8,200 range early in the week. Bitcoin pushed towards the upper near 80,000 on the back of Nvidia's strong earnings and general risk appetite. It gave back some ground on Friday alongside with the equity sell-off, closing the week about 77 to 78,000. And when I was trading it earlier this afternoon, I was trading it somewhere in the 77 100 to 77 350 range, somewhere around when the market's fully closed. I don't know what time that is here. That was 3 o'clock. Bitcoin to 75K may be lower. Quantum Queso Dip says, yeah, I can see that happening. With the Crypto Act or the Clarity Act getting some pushback, some outflows. We had Mark Cuban opening his face about selling all of his Bitcoin. Honestly, that feels like a great bottom indicator because, like, another good indicator of like a bottom is when Germany sold all their Bitcoin at like 55K. I wonder if they've started buying back. I'm gonna look into that over the weekend, see if Germany started picking up their position at all. But Mark Cuban, who cares? You're just clamoring for relevance. Just sell the Mavericks and move on or something like that. I don't know. But if it gets back to 75K, cool. But I'm going to keep trading the 15-minute price action, and I think I'll be able to really enjoy that chop, right? Because if it's got a hard ceiling, it's just going to be easier to say, nope, it's going to come down until we get a more clear environment for the risk appetite that is Bitcoin. And with the overall price on yields, the housing market, people just may not be as risk averse when those things come down and Bitcoin price will go up. So I think it feels like a good consolidation area. Yes, Mark Cuban, huge clown. Why you gotta come out and do that today? Like, this seems like the most ridiculous time to sell all your Bitcoin. What are you doing? What are you doing? What are you doing, Mark? Ugh, whatever. He can do whatever he wants. He's a billionaire. Friggin' Shark Tank. But the correlation with the market, excuse me. Bitcoin moved in tandem with tech early in the week, but showed relative strength on Friday, acting more like digital gold. I don't really like that, but it fits for people who don't understand it. Amid rising geopolitical inflation fears, ETF flows were mixed. We saw continued institutional interest via BlackRock's IBIT and others, but there were also some outflows days midweek as investors rotated into energy and real assets. With the higher treasury yields and elevated oil prices created a tougher environment for risk assets, like I said, including crypto. However, Bitcoin's narrative is an inflation hedge gained some traction. Not quite sure if that's the case. We're getting a great floor, so it seems like since the inflation has been going up and Bitcoin has been going basically sideways, that's a good indicator of a hedge type situation because this gets more expensive and this stays stable, right? It's not moving against each other. So I can see that as well. Here's some of the broader crypto sentiment. Ethereum and major altcoins were mostly range bound and outperformed Bitcoin just slightly. On chain metrics remain constructive with steady accumulation by large holders. Regulatory tailwinds, like I said, Clarity Act progress and cleaner stablecoin rules continue to provide long term support. Bitcoin continues to act as a barometer of sorts for risk sentiment. While it doesn't break out to new highs this week, holding above 76,077, right, as we were trading today, in the face of rising yields and oil pressure, is a positive sign, like I covered. The asset is maturing. It's no longer just moving with NASDAQ on every tick, and that's kind of nice. Now, my beloved Hood, ticker Hood, Robin Hood. Oh man, I wish they would decouple a little bit. That would be just great. RVI is still trading relatively high, above 55, under 60. But man, Robinhood is just getting its face kicked in. But also some of the other retail love stocks like SoFi too. Now I don't cover a lot of SoFi because I barely have a whisper's worth of exposure. I think it's inside of an ETF I have. They might have even taken it out. I don't even know. But as far as next week goes, Bitcoin will likely key off on three things: oil, geopolitical developments, and the 10-year yield direction. And whether risk appetite remains after this week's rotation, I don't know. A break above 81,000 would be a technically bullish term, but I don't know. Well, a loss of 76,000 down to 75,000, like Quantum said, support would open the door to deeper correction territory area, maybe 70. I don't know. It's outside the box. So once it gets outside my box, then maybe we can start messing with it. Long-term holders remain unfazed. This still looks like digestion with a larger uptrend driven by institutional adoption and on-chain economy. Ah, man, what a week. Ugh. So many things to keep your eyes on, right, as traders. Quantum says Bitcoin will be back at all-time high by the end of the year. This is a popular prediction. I'm pretty bullish on that. I know traders are always going back and forth whether it'll even reclaim 100,000 this year. But we know as crypto holders and Bitcoin enthusiasts that this asset just poof, all of a sudden flies one day and just keeps rising. Risk on, appetite is good, and we could be seeing 85,000, 90,000. I mean, let's take a look at the Bitcoin chart here for a moment. I think we got some nice action going on, and we can see what's going on all together. Now, Bitcoin's all-time high, for anybody who doesn't know, is around 127,000, give or take $500. Okay, here we go. All right, so as you can see here, Bitcoin is currently at 75,342, so it's down off of where I was trading it earlier today, but it's getting closer and closer to coming outside of my box here, right? And so when it's outside my box here, this is when I know we've got sort of a bottom looking area. Now, I don't know that for sure. As you can see, it got down to 59,000 at one point, but did not get there, right? It tried to get here at 62, another 62, 65, right? So we're getting lower lows out of this. I don't see any huge sell-off signals, huge candles. Like, we look back here at Bitcoin, look how large some of these candles were and how much people were just sell, boom, sell, boom, sell. Like, it just could not reclaim it, and that's okay, right? Because now we're out here and you can see all of the moving average lines are compressing together and becoming sort of this springboard is a good way to look at it. Now, the overall storyline for Bitcoin and on-chain may not be great right this second, but things change very quickly, right? So if you are considering a position, as you can see, we have found sort of a floor, right? This is a decent looking floor. If I was just to blindly look at this chart without knowing what I'm looking at, I would say this has found a strong support. So if you're looking to pick up Bitcoin or find some exposure to on-chain, Bitcoin is an indicator for the entire cryptocurrency market. So if this has found a support, a lot of the things you're looking at might have found a support too. I'm not 100% sure. I don't own everything. The things I like, I buy. And Bitcoin's inside of that orange box, so I'm not into necessarily buying directly. Now, I will trade exposure, I will trade ETFs. Like I said, I'll trade on Kalshi, and I'll trade the 15-minute price targets. It's easy. Will it be above or below this line? I'm wrong sometimes. I was wrong today, but I wasn't wrong all the time. And that's the most important part. Excuse me, I got a bit of a cold. There's a lot of fog going around here. Volcanic ash creating particles in the air, like a fog that affects upper respiratory systems throughout the state. So excuse the sniffles I have. But as you can see, I think Bitcoin has found a great support area here, right? Like, I think we're good. And it's slightly bullish, and if we were to reclaim, I can see it happening. As you can see, this here, that was October, right? Where we are here, when it sort of found its bottom, was February. October, November, December, January, February. So that was 5 months. So in a 5-month period, which we have more than enough with the rest of the year, we could see it reclaim this 126,000 272, which is the high on this chart. Now there might have been a spike or something. I don't know. Maybe it got higher, but that's the high on this chart. Now, if we look back as a clear-minded individual, you can see that the market gave us some signals that it hit a bit of a top, right? Once, twice, 3 times you're out, and it's the old ball game, right? Boom, 3 times, done, right? So we got kind of 3 here, and I think we might be on our way out, but I'm not quite sure. It feels supportive, and I dig that. I'm happy about it. But this is sort of the average degree of fall that we're getting, right? So the top from peak to trough are roughly the same. That's nice, right? Peak to trough, roughly the same. So it's just nice and supportive in an overall violent market, and that's a great thing to be able to see. Now moving forward for Bitcoin, I'm going to continue to hold the exposure, hold on chain, and move assets towards AI. We have got more confirmation on when SpaceX is going to IPO. Also, Sam Altman's OpenAI is going to IPO in like the same week. Also that week, or that within those couple weeks, we're going to get the pattern day trader rule is going to go into effect, where it changed, where you don't need as much money in your portfolios to be able to day trade. Holy moly. So we're going to get OpenAI, SpaceX, and pattern day trader rule change all in 1 month span, maybe even a week span. Man, the markets are going to be falling apart. We're going to see like huge VIX spikes, but for positivity. I don't know how that works, right? Does a VIX spike and the markets go up? I don't know. We have to check that. This is an unprecedented level of IPOing here. Like, there's no other IPO that's going to top the SpaceX IPO coming out this year. I'm looking forward to it. I'm still digesting the amount of where I want to put the exposure. Like I said a few weeks back, you got to consider, what's the point of holding an pre-IPO asset when you could just buy the asset on the day it IPOs, right? So I can see people taking the profits of the pre-IPO momentum and then putting it directly in the SpaceX shares. Why not just own the shares directly, right? It's sort of like Bitcoin in that way. You can buy exposure to it, but now that you can buy the actual asset itself, you might as well buy the actual asset. So I think we're gonna see sell-offs of DXYZ as well as VCX. Well, I don't know if they can even sell off. I don't know enough about VCX to know if they can sell off. I know they have a hold or something till September. Correct me if you see this. Just leave me a comment. But before I trail on into madness, and this goes on for another 45 minutes, let's get into some takeaways. We've covered a lot already today, from record highs on Friday, record highs to a Friday sell-off, bond yield spiking, Nvidia strong earnings, quantum computing getting a huge boost. That's great for our portfolio as IBM holders, and persistent oil and geopolitical tension. Here are the main takeaways from this week. Market resilience with rotation. Stocks hit new all-time highs midweek, but closed near flat after Friday's pullback. The big story was sector rotation. Energy materials and industrials outperformed, while high growth tech gave back some gains. Broadening is healthy. Bonds under pressure. Yields rose sharply, with the 10-year hitting 4.59 and the 30-year above 5.12. The bond market is firmly pricing in a higher for longer due to sticky energy-driven inflation. Nvidia delivers, but another strong earnings beat, yet reaction was muted. It validated the AI thesis, but showed how high expectations have become in this environment. Oil and geopolitics are still in charge. Elevated oil prices due to Middle East tensions remain the dominant macro force, feeding inflation fears and supporting real asset outperformance. It closed somewhere above $100, 102 to 109 is where it traded. Bitcoin holds steady. Bitcoin consolidated around 78,000, showing relative strength and acting more like digital gold amid uncertainty. Digital gold being it's getting giving off a hedge vibe, right, where you can put capital towards that to protect against rising inflation. The market is digesting higher yields and energy costs while still rewarding secular growth themes: AI infrastructure, energy, and on chain. It's a stock picker's environment rather than a simply buy everything rally, right? So if you're not a stock picker, just dollar cost average into what you love and it'll bounce back at some point. There were some things that just fell off after earnings did well. I know Intuit, I think is what it's called. They do TurboTax and QuickBooks. They fell off. I was doing a little bit of side study on that for a friend, and I noticed that they had a pretty decent support, somewhere about the 350 range. But I'm going to bring up the chart real fast, and we can see how they didn't really support that line, and it fell through. Now, when I offer any kind of, not advice, but my opinion on a chart, I'm happy to give an opinion. If you ask me a question and you're curious on if this is a good time to pick up a position in something, sure, I can use my semi-amateur journeyman knowledge to help you out. So here's the Intuit chart from this week. So this was a pretty decent support area right here, this 350 range. And it was supported farther back. I'm going to pop this farther. Right, so decent support area right here, 380, 400 range. But because of what's going on, as you can see, it traded well, and then boom, right? It got to an all-time high of 800. This was last July. I don't know. I'm looking over here. This is not where you are. You're over here. But last July it hit 813, and then that was it. Poof. I don't know why it came down. It tried to find this nice support area, could not hold it early January, and came down. And that could have been due to taxes or the fact that a lot of people aren't using TurboTax to do their taxes. I personally didn't have to this year. Robinhood had a free tax preparer right in the app. It already had all of my information. 20 minutes basically. Not even. It was maybe 10 minutes. And then all was done. So I can see how they're taking a hit. Now they have a lot of members or subscribers, over 100 million to their QuickBooks. But with QuickBooks, I can see automation coming in and changing that as well. So I was getting into a couple of discussions with some people online as well as some friends, and they all had different kind of opinions on this. Yes, it could get back to 800, but I don't see the use case for this company moving forward. Do you see QuickBooks being here in 10 years? Look how hard Adobe is dealing with the environment around computers. Computers are not what they used to be, right? They aren't about retrieval, right? Computers are now about generating. And if your computer is not generating something, or your product isn't generating something, you're going to have a hard time, because this is a SaaS type of company where they sell software as a service. So I can see why they're having a hard time. For instance, I'm pretty bullish on Ramp because of this chart, because Ramp has their finance automation. Now, if you can start automating to normies and not just businesses, that's it. TurboTax is dust. As well as, well, Intuit is probably gonna hit the 2020 area of, where was it? Let's see. How bad did it get? Like, okay, so here, like, this is the next support area. Since it broke that one, right? Look at that candle. It's an island. This thing is just floating out here. That's not a good signal. Either it's going to try to retest it, but look at the moving averages. Everything's falling. Momentum's not with it. This company's going to have a hard time moving forward just based on this chart. And look at it, 260 back here in 2019. And that's not even a hard ask. Imagine being a shareholder from here, and then 7 years later, you're right back. That's so depressing. Sorry if you're holding Intuit TurboTax, and if the person that I gave some opinion to took it, thank goodness, because if they didn't, they would have bought at 330, and who knows how much they would have lost on that position, because that's a $20 drop from there. But if you're looking to get in, you can get in even lower. Like, it got to 300 flat. Now that might be a support area it might be looking at. I don't know. But with that being said, thank you for trusting me with some of your asks. Thank you for trusting me with your thoughts, because it's hard to figure out where to put your money. You can put it anywhere now, but money won't grow everywhere. Sometimes it grows faster here and slower there. So you always have to consider what your time frame is. The market is digesting higher yields and energy costs while still rewarding secular growth, like I said. But this week reminded us that the markets can hit records highs and still feel uneasy at the same time. The combination of strong corporate fundamentals and external pressures is creating volatility, but no signs of major breakdown for as far as I can see. Now, I'm one guy in the middle of the Pacific Ocean, so I don't have 2020 foresight. My hit rate is pretty high, but it's not perfect. I'm still learning a lot of things. I've only been doing this a few years, so I understand what I'm looking at, but I don't always understand how to achieve what I'm conceptualizing. And luckily, with AI and generative technology and agentic tech, I can get a leg up and kind of close the gap on some of the individuals who have been in this game way longer, right? Because experience is huge in any type of masterful environment. Anything you want to do well, you need experience doing. But anytime you can learn from multiple avenues, it's the better for you. I'm learning right here. The more I digest the markets for you every week, the more I can kind of think about them over the weekend. I'm speaking it out. I can hear myself talking, right? So for you as a shareholder or a market enthusiast, speak it out loud, right? Talk about what you're trying to do. Even if it's to the mirror, then you really can kind of solidify whether, hey, is that a good idea, or is my brain playing a little bit of a game with me? Now, with that being said, thank you so much for being with me today on your weekly market outlook. I'm your host, Colin Edsman, and as always, farewell, ahoy ho. Thank you, Quantum Queso Dip, for joining me in the chat today. Stay safe, and I will see you on the porch.